Welcome to the Rent Roll Queen podcast. I'm your host, Tarsi Taylor. Running a real estate business can be tricky with so many aspects to navigate. In this podcast series, I am going through everything that you need to know about running a real estate business, whether you're a seasoned real estate business owner, new business owner, or somebody trying to get into entrepreneurship. This podcast is for you. We're working through social media, buying and selling rent rolls, and how to have a profitable business. So follow, like, and subscribe, and don't miss an episode, and don't forget to share this with your friends in real estate. Welcome to the Rent Roll Queen podcast. I'm your host, Tarsi Taylor, and today's episode is brought to you by BARR Rent Roll. Do you know the true value of your rent roll? Today, I chat with John Knight from Business Depot about rent roll valuations. Welcome to the show, John.
Hi, Tarsi. Thanks for having me along.
Oh, it's great to have you. So can you please introduce yourself?
Yeah, my name is John Knight. I'm the Managing Director and Founder of Business Depot. For all my sins, my background, I'm an accountant and specialised in the real estate space for decades now. But since forming Business Depot just over 10 years ago, we've added other services into the mix. And so as the name suggests, from accounting to legal to rent roll broking to tax and self-managed superannuation, the idea is to be that depot for business owners.
Yes.
And in particular, real estate industry is an area that we specialise in.
You do, and we've known each other for quite some time. So
we won't use decades to describe that.
We won't. It just makes us feel old, so we're not going to do that. But what's really exciting is you would see a lot of rent rolls come through, because obviously you have your brokerage arm, but you also do accounting and so forth. And the values of rent rolls, which is what we're talking about today, they have changed over the course of our decade that we're, that in business. So I'd really just want to touch base on getting a clear understanding of what value actually is on a rent roll, because a lot of people don't get that.
And it's really interesting because I see it from multiple different perspectives. Now, I mean, I don't provide every service in every division. I've got other people to do that. But still, as an accountant for somebody that you're not doing the sale of a rent roll for, you see different approaches and different values sort of come into play. So we see it from a lot of different angles. And I mean, there's the classic answer to what drives value in a rent roll, isn't there? There's all the data.
Yes.
There's the double AMI, the annual management income, and there's the vacancy rates and the multiple owners, and there's all those different sort of things. But when people talk to me or ask me about value, I actually take them down a bit of a different sort of path.
Take us.
I will talk about, yes, there is the multiple of income sort of style valuation, which is really market-based valuation. But as someone who has been doing business valuations for all industries over my entire career, I like to bring people back to that multiple of EBITDA or multiple of profit as well. And the reason I do that is because even if it's a rule of thumb valuation where it's a multiple of income, we've got to make it stack up still as a multiple of profit.
Yes. Okay, so can we explain to the listeners what EBITDA and EBIT actually is?
Okay, so EBITDA is earnings before interest, tax, depreciation, and amortization. It's an accounting term. I'm very sorry. But it's basically trying to come up with what's the profit that we're really making from this before you pay interest, before you have any depreciation on any assets and those types of things. Now, you can also have that. Now, EBITDA is just, I suppose, your reported figure. But if we're doing a business valuation for a business in a different industry, we're actually going to try and work out what their future maintainable earnings are. So we're trying to estimate what we think this business is going to make on a maintainable basis into the future. And that's the figure that I think we need to probably give a little bit more attention to, because your reported EBITDA is an historical number, but we need to be future focused and we need to normalize it, I suppose.
Yeah, and for rent rolls, we are looking at their rent roll statistics, and the way I explain it is you're literally taking, remember the old the cameras, the Kodak cameras, you're taking a snapshot in time and then basically creating the value over for the next 12 months. That's what the valuation actually is based on.
Absolutely. And you're going to have a look at what's good about it and what's bad about it.
Yeah.
What's the risks in it? What are the opportunities within it? So when we get all that data on a rent roll, which one of the great things about this industry is we have awesome data on the industry, but you can also get from that data what's going well within this rent roll or what's not going so well. And obviously, the more risk,
Yes.
that it's not going to continue to make good money or not going to continue to grow. You're going to want to pay less for it.
Yeah.
The more opportunity for improvement, the more opportunity to grow, the more consistency, you're going to pay a bit more for it.
So let's talk about those risks then that are associated with what can devalue a rent roll. So do you want to run us through that?
Well, I mean, there's a stack of things, but one of the ones I always like to talk about is the multiple owner sort of discount.
Oh, yeah. Here we go.
And principals are often surprised when they've been trying to grow their rent roll over the years and they get one owner and he's got 10 properties and he goes, great, that's going to jump up my income, which is fantastic, by the way. But when we go to value it or when someone goes to value it, we look at it and we go, well, there's a risk. That one owner leaves, there's a risk that we're going to lose a big chunk of our income. And so I don't know about you, but more often than not, if there's a big chunk like that, we're seeing a different multiple applied to those types of things.
Yeah, I've seen it. And this is where the contracts are really important, because if the contracts are showing us that, yes, we're assessing that risk, we're able to assess that risk separately.
Yeah.
But if you've got a lot of rent rolls that include that, then we have to basically take that into consideration.
It's a bit like the whole geographical spread, which we all talk about. You know, a big geographical spread within a rent roll, which means if I'm buying that rent roll, I'm getting all these properties all spread around, which potentially aren't as efficient as a rent roll, which is nice and tight in a particular suburb. And so, again, I don't know about you, but I'm seeing a different multiple applied to those outlier properties.
Yep.
Or even the buyer saying, I'm not buying those properties.
Yes. Yeah, that's a lot because it doesn't actually fit their model. So they want that particular rent roll specifically for that condensed location, and all of a sudden you got stuff like, you know, let's say we're in Brisbane, you got them out at Ipswich, Toowoomba and all the rest of it, and it just doesn't flow.
Well, it makes your business less efficient, doesn't it?
Well, you got to hire more staff, don't you, to operate it.
Like my accounting and advisory teams, they're out there talking to people about how to improve their business, and we might talk about buying a rent roll to reduce their break-even point. But if we buy a rent roll and then there's these dozen properties that are causing the property managers a bit of a headache, they're not worth as much to you. So my advice is, well, don't pay for it. Don't pay the same amount.
That's the actually easy way. But a lot of sellers want to sell that whole rent roll. So you've got to kind of take it on. But realistically, you can then package those up to sell, to on-sell. You don't have to sell 200 properties.
Oh, look, I love small parcels of rent rolls. Like I love when someone packages up a dozen or 20 properties. The buyer doesn't tend to have to go to the bank to get the funds. They've probably got the cash sitting there. They can just negotiate. They're only going to pay if it comes across. And it's good. It's a win-win sort of situation for the buyer and the seller in that situation.
And that provides more value as well. Like, you know, when you're looking over it, and we're talking about values, but you've got to look at your operating expenses if you want to create more value into your business.
Well, I mean, when you look at valuing a business and, you know, what are you getting with that business? And so sometimes you'll be buying just a rent roll and you'll just be bolting that on to an existing rent roll. But sometimes you're buying the whole business and you're taking on the premises and you're taking on the sales team and you're taking on a whole heap of commitments. I encourage people when they're doing the due diligence on those purchases to just make sure they're really clear on what they're buying and what they're getting. Because the old rule of thumb on the top line sort of value, yes, supply and demand drives that's how they are transacting.
Right, yes.
But from a business perspective and a due diligence perspective, I want people to be really, really clear on what they're buying.
Yep. And when we talk about the rule of thumb, I want to make it very clear to our listeners what a rule of thumb is actually adopted on. So what does that actually mean?
So the rule of thumbs is in the industry is a multiple of income. So gross management fee income is typically what it's sort of contracted.
In other words, excluding GST, guys.
Excluding GST and excluding things like letting fees and things like that.
Yep.
Sometimes you will have people negotiate different things, but the traditional sale of the rent roll is a multiple of the management fee income. But we will take into account the other fees that you are able to derive once you've got those properties under management. Of course, that's just a rule of thumb though.
That is the rule of thumb, but then we've got to support it, right? As valuers, our job is to actually support that multiplier is true and correct. Is that income true and correct? What are the operating expenses of running that portfolio? What does that net profit look like? So that's important too.
And also, let's not forget that this is a unique industry where the retention is a very important part of a sale process. Not every industry has such an ingrained process around protecting the buyer.
Yeah.
You know? And so because of that, buyers will pay a higher multiple knowing that if the property doesn't actually come over, they don't pay for it.
That's right. So, and, we've got to take that into consideration. And, retention is something that's not very well understood, unfortunately.
And it's also where you can have some of your biggest losses in a sale process if you don't do a great, I suppose, management. If you don't manage that process really, really well, you can lose a sizable chunk of your portfolio.
Well, you can, and we've both seen that actually happen. It's pretty sad. And then, you also do like valuations, because let's talk about valuations where they're buying the actual company itself, so the shareholding into that business.
What's becoming more common, especially in Queensland, where there's no stamp duty on the purchase of shares in a company, but there is stamp duty on the purchase of a rent roll, which is a sizable amount for some of these rent rolls. And so the idea of buying the shares in the company that operate the rent roll is becoming more and more common. It's got some headaches around it.
It does.
It's got some different, I suppose, due diligence steps that you need to follow. The legal contracts are a bit more complicated and some of those types of things. But, the buyer tends to not mind the idea because they don't have to pay stamp duty. The vendor doesn't tend to mind the idea because they often get a better outcome from a tax perspective, depending on their legal structure. And so we're seeing more and more of that. But people have to be really clear again on what they're buying. If you're just buying a rent roll, you're just getting those properties. If you're buying a company, you're inheriting the history of that company. You're getting the leave liabilities of the employees. You're getting the equipment that's in there. You're getting the related party loans if they haven't been cleared out yet.
Yes.
So it's more complicated, even though there can be a sizable tax saving on the stamp duty.
I personally don't like them. But that's just a personal opinion.
I know, but there's other benefits as well in them. It's not just the tax, because if I'm buying a rent roll and it's in a company already, then you don't have to change ABNs. You don't have to necessarily.
There are upsides
the admin
of it.
Might be easier as well. I'm not advocating it.
Good.
No, because you've also got to remember the compliance side of things.
That's right.
You then have to manage a rent roll that is spread across multiple entities.
Yeah.
If you've already got an existing rent roll as well.
Yeah.
There's pluses and minuses. My comment is probably more that is happening more often.
Yes.
And people are more open to it. The legals have got more complicated to deal with it, but you need to know what you're buying. So you need to know what's in that company.
You need to know the history behind that company. Otherwise you will get, I know I've seen it. Like I've had a client recently where there was issues with previous staff that wasn't known, and then there's a work cover claim. So, and then that's another thing that they have to work through.
Well, then you've got to go through the legal process of making sure that the purchase contract has the appropriate indemnities for past activities.
Yeah, I don't think this one did, unfortunately. So that was it. And again, you got to really work with, and I know you guys do solicitor.
Yeah, we do.
You're a legal side as well. Yep. So you would see some of the headaches that basically come through, which could devalue rent rolls because of what's actually happened, or create major brand damage to a business. So, brand damage is another place that we don't actually look at values as clearly, because obviously we go rule of thumb says, but then you've got a rent roll that all of a sudden has brand damage, businesses walking out the door, there goes half your value with it.
Yeah, it's an interesting industry in that regard, because you can have a property manager walk out the door as well.
And take the business
business with them at the same time, which is why this retention sort of strategy or retention component of a deal, I think, has come about within the industry.
So, when we're talking about like staff leaving, so you've just touched on something really amazing, right? So staff leaving, and where we see that, the property manager, then she goes, I'm going to go and open my own business, starts their own business, and all of a sudden they're taking managements with them. What can a business owner do legally to protect themselves at that point?
Yeah, I mean, probably a better question for a lawyer, but my understanding is there's not a lot you can do, because you can try and get that employee restrained through the sale process, but they don't have to agree to anything.
Yeah.
You can make it worth their while to agree to something.
Yeah.
But my understanding is that you can't force them to do anything, except I suppose their employment contracts, where they'd have employment contracts with the entity.
With the entity. Just such an interesting time in our industry, and we do see that happening a lot. So with business owners, what can they do to create a better value for their portfolios?
Yeah, look, I mean, what I actually encourage people to do first is to be sale ready. So actually think about the whole sale process. Actually look at the data before they sell it. Look at their forms. Are their forms compliant? Maybe even do the due diligence, do a vendor due diligence before you even list it for sale, and get your house in order to maximise your value before you get an actual valuation or before you go through a sale process, if that's what you're looking to do. And so by getting sale ready, it's looking at everything and looking at your data from the lens of an outsider.
Well, that's right. And that will actually uphold your value when you go to sell it. It's like a property, right?
Yeah.
You know, you want top dollar.
Yeah.
Well, you've got to renovate the property to make sure
maybe you got to tart it up a little bit and put some furniture in there and make it look a bit better. But again, that's just what can you do to make it better? Yeah. And so I know clients that get a valuation of their rent roll done every year.
Yes.
No intention of selling or anything, but they get a valuation done every year, and they come back next year and they quiz the valuer as to whether the multiple's gone up, and if not, why not, and what do I need to do to improve that? So if you ask that question, what do I need to do to improve my value?
Yes.
And they give you an answer, and you go away and you do that, then you got really good ammunition to increase the value when you come back again.
Yeah, and what's exciting, you know, those clients that get a valuation done every single year understand very well their position, right? Which allows you to either trigger a sale, go buy a rent roll to grow, or budget better.
Or fund their business better.
That's it.
Generally, you know, it's good information. I mean, real estate businesses are interesting and unique in many ways.
Really
even though they're simple, they're interesting and unique because your sales business is very different to your property management business. And I don't know about you, but it's the property management capital value, which is what everybody's chasing. It's also what we're chasing from a break-even point to reduce the risk within cash flow and operations and those types of things. And so if you're not measuring your key output or your key thing that you're trying to create, then how do you know whether you're actually winning or not?
That's it. Oh my gosh, you literally nailed that, nailed it. And it is really important for business owners to actually understand their value because if you don't understand your value, where are you actually going? What are your metrics? Can you actually grow your business? Can you trigger a sale? What does your what are your property managers doing in the back end? Are you collecting all your fees and charges? These are such important things. Or what are the
risks that that's not going to continue? What if how reliant are you on a key person within your business?
Oh gosh, yes.
But it's business. Sometimes I think the industry needs to think more like a business owner than, I don't know, dare I say a salesperson, and think about the bigger picture sort of plans and where are we now? So you got to know your data, you got to know what's good, you got to know what's bad, you got to know what you need to improve. Where do we want to go to? And so are we creating a capital asset or are we just creating great profits on the way through? How do we want to take risk out of it? Do we want to be reliant on the principal or someone else?
Yep.
And what's the gap and how are you going to fix it? And that's where I think the valuation process is really important if one of your strategic goals is to grow significant capital value through a rent roll.
Yep, I'm completely agreeing with that because it's so important to have a vision of where you are driving that business and then create it. And the best way of doing that is upholding the value of your business, not understanding that it is your saleable asset.
Yep.
It is. Your sales division will sell as well, but not for the amount that a rent roll is going to sell. So your focus, although it needs to be on sales for commissions and so forth and market presence, your rent roll is your saleable asset and what will actually assist you in either growth or exit.
It's actually why the industry works so well in that we've got two very different types of businesses. Sales business, typically high profit, high cash flow. If it's got good growth and it's doing well. Property management, cash flow is a bit lighter on the way through. You're not making your money on the way through, but you make your money at the end.
That's it.
Assuming you can get a sale away, of course.
And you know what? These transact all the time. So, and what's really important for business owners to understand is that your multiplier can only be what has actually happened in the marketplace. Every now and then we'll see one that like a sale that goes through. You had a great one recently, and it was a 3.5 times multiple. Now this is Queensland, and it was on the Sunshine Coast, and it was the highest multiple that I had seen in the industry up to this point for a really long time. And it was an incredible achievement, absolutely incredible achievement. But everyone has to understand, just because that got a 3.5 times multiple
doesn't mean every rent roll's worth 3.5 times.
Exactly. And it comes down to the statistics around your portfolio, you know, your market data, your analysis, your income that it's actually producing. This portfolio was actually producing quite a high annualized earnings per property. And so, and the business owners as well were actually going to form part of the retention,
so basically. They took risk out of it.
Yeah. So because of that, it achieved a 3.5 times multiple. So the guy down the street may have less income, a different commission rate, a lower commission rate or a higher commission rate, different average weekly rent, vacancy rate, arrears rate, landlord to property ratio. So when you're looking at all these things, yours might not get 3.5.
And rarely will it.
Yeah.
Rarely will they be identical. I think the other thing that highlights is the difference between price and value.
Yeah.
And it's no different to the real estate agent selling a block of land or selling a house, I don't know, in Clayfield or whatever suburb. The guy next door might see more value in owning the neighbouring property than the lay person on the street who's just driving by and decides he'll have a look at that property.
Yeah.
And it's no different in business. The value of a rent roll to one particular buyer might be even more than our technical fair market value because it gives them greater market share, or it gives them a bigger sales team, or it gives them some other growth or market benefit over and above just the fair market value that rent roll might get.
Yep. So those multipliers, guys, that you hear in the marketplace, you've really got to dig a little deeper to actually find out. But don't get me wrong, if 3.5 becomes the norm, then your rent roll might likely achieve a 3.5 times multiplier. But if it does not, then that was a once-off and you need to actually have a look. The same way if it was like a 2 times multiplier, let's talk about in residential, and everyone around you is getting a 3 times multiplier, you got to actually really have a look and see what's actually going on.
What's going on. And it could come down to the terms of the actual deal as well. So like you said before in that example, the vendors were staying on in the business and going to work in the business. That takes risk out of it, so I might be willing to pay a bit more in the multiple. You've got to look at the whole terms of the deal and understand the drivers behind it as well. Yeah.
John, I want to say a humongous thank you for coming in today and talking to us about rent roll values. I'm going to put all your details into the caption that anyone that wants to reach out can definitely reach out and discuss those with you as well.
Awesome. Thanks for having me, Tarsi. Great to chat.